Every major financial crash in the last 100 years has followed the same pattern. Not similar patterns, the same pattern. 1929 followed it. 1987 followed it. 2000 followed it. 2008 followed it. It's a 5-stage sequence that appears months, sometimes years, before the collapse actually happens. Wall Street knows about this pattern. The Federal Reserve knows about it. The people who manage money for billionaires definitely know about it, but you've probably never heard of it. Because if regular people understood what to look for, they'd pull their money out before the crash instead of after. I'm going to walk you through all 5 stages today. And I'm going to show you exactly where we are in that sequence right now. Spoiler, we're further along than you think. In 1929, a man named Roger Babson gave a speech at a business conference. He said 9 words that made him the most hated man on Wall Street. Sooner or later, a crash is coming and it may be terrific. The audience laughed. Newspapers mocked him. Irving Fisher, the most celebrated economist of the era, dismissed him publicly, declaring that stocks had reached a permanently high plateau. 47 days later, the market collapsed. Pfizer lost everything. He died in poverty. Babson didn't die in poverty. He made millions. He founded a college that still trains business leaders today. And here's the part that should terrify you. Babson wasn't lucky. He wasn't even particularly brilliant. He just paid attention to a pattern that Wall Street has spent a century pretending doesn't exist. On September 5th, 1929, Babson stood before the annual National Business Conference and delivered a warning that would go down in history. The market dropped 3% that same afternoon. They called it the Babson break. Wall Street ridiculed him. The Chicago Tribune published rebuttals from every major economist. They questioned his patriotism for daring to suggest America's prosperity had limits. Irving Fisher, Yale's star economist, responded with absolute certainty. He told the world that stock prices had reached what looked like a permanently high plateau. Fisher had a net worth of $10 million in 1929 money. That's roughly $150 million in today's terms. He was heavily invested in the market, particularly in Remington Rand stock, which he'd bought on massive margin. 55 days after Babson's speech on October 29th, the market went into freefall. Fisher didn't just lose his fortune. He lost $11 million, which meant he went $1 million into debt beyond his entire wealth. His sister-in-law bailed him out repeatedly until she finally cut him off. Yale bought his mansion and rented it back to him. He spent the rest of his life borrowing money from family members. When he died in 1947 at age 80, he still hadn't recovered financially. The man who dismissed Babson's warning ended up as a cautionary tale about the cost of ignoring patterns. But here's what almost nobody knows. Babson had a system. He tracked 5 specific factors: credit levels, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities. 5 factors, 5 stages. And they appear before every major crash. I spent months verifying whether this framework actually holds up across different eras, not just 1929, every crash, 1987, 2000, 2008. And what I found should make you extremely uncomfortable, because all 5 stages are either active right now or approaching fast. Every crash begins the same way, not with panic, not with greed, with debt. Before markets collapse, there's always a period where credit expands faster than the real economy can absorb it. People borrow money they mathematically cannot repay. They use that borrowed money to buy assets. The buying pushes prices higher. Rising prices make people feel wealthy. Feeling wealthy makes them borrow even more. It's a feedback loop that feels exactly like prosperity. But it's actually a trap being constructed brick by brick. In the late 1920s, margin debt exploded to levels that seem insane in hindsight. Ordinary Americans were putting down 10% and borrowing 90% to buy stocks. By 1929, total margin debt in the market equaled the entire federal budget of the United States. Factory workers were leveraged like modern hedge funds. In 2007, it was mortgage debt. Banks created exotic financial instruments that allowed people to buy homes with zero money down. They packaged those mortgages into securities and sold them to pension funds. The leverage was hidden in layers of complexity, but it was everywhere, embedded in the system like a virus waiting to activate. In 2000, it was corporate debt. Companies with no profits borrowed billions to fund expansion plans that made no economic sense. They used their own stock as collateral. When stock prices inevitably fell, the entire structure imploded in slow motion. Now look at where we stand today. Official margin debt sits around $750 billion, but that number is a carefully constructed lie. It only captures a tiny fraction of the actual leverage embedded in the financial system. Add in securities-based lending, where wealthy individuals borrow against their investment portfolios, and you add another $800 billion. Add in the leverage hidden inside options markets, where small amounts of money can control massive positions, and you're looking at trillions in notional exposure. Add in corporate debt, which has exploded past $10 trillion, much of it used not to build businesses, but to buy back stock and inflate earnings per share. Add in government debt, which has crossed 36 trillion and requires interest payments larger than the entire defense budget. As a percentage of GDP, total debt in the American economy is now higher than it was in 1929, higher than 2008, higher than any point in recorded history. Stage 1 isn't just flashing red, it's on fire, and almost nobody is paying attention. Here's something they never teach you in business school. Crashes don't happen just because prices are high. They happen because risk is concentrated in too few places. When a small number of assets carry a disproportionate share of the market's value, the entire system becomes fragile. All it takes is one of those assets to stumble and everything connected to it comes crashing down. In 1929, the market was dominated by a handful of glamour stocks. Radio Corporation of America was the superstar. It went from under $2 to over $500 in just a few years. Nobody actually understood radio technology. They just knew the stock kept going up. RCA made up a massive percentage of the market's total value. When it finally cracked, the whole market cracked with it. In 2000, it was the dot-coms. Cisco, Intel, Microsoft, a handful of tech names. The NASDAQ was essentially a concentrated bet on 10 companies. When those 10 rolled over, trillions in wealth vanished almost overnight. In 2008, concentration was cleverly hidden inside the banking sector. 5 banks held the majority of derivatives exposure in the global financial system. When Lehman Brothers went down, it nearly took the entire system with it because of how interconnected everything had become. Today, the concentration is staring us directly in the face, and somehow almost nobody seems concerned. The top 7 stocks in the S&P 500 now account for over 30% of the entire index. At certain points this year, it's been closer to 35%. Think carefully about what that actually means. When you buy an S&P 500 index fund, which is what sits inside most 401ks and retirement accounts across America, you're not really buying 500 companies. You're making a massive concentrated bet on 7 companies: Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 stocks drop 50%, your supposedly diversified index fund drops 15 to 20%, even if every other stock in the index stays completely flat. And here's the thing that should keep you awake at night. Those 7 stocks are all trading at valuations that require absolute perfection. Not good earnings, perfect execution, perfect growth. Any disappointment, any slowdown, any crack in the narrative, and the selling will feed on itself. Passive investing has made this problem exponentially worse. Every dollar that flows into an index fund automatically buys more of the biggest stocks, pushing their prices higher, increasing their weighting in the index, which means the next dollar that comes in buys even more. It's a momentum machine that works beautifully on the way up. On the way down, it reverses. Every dollar that flows out automatically sells the biggest positions first. Forced selling creates more selling. The machine runs in reverse. This is stage 2, the concentration trap. And we're deeper in it than we've ever been in market history. This is the stage that makes me angriest, because it reveals exactly how the game actually works. Before every major crash, there's a period where institutional investors quietly reduce their exposure. The banks, the hedge funds, the family offices, the billionaires, they sell their positions, they raise cash, they buy protection, and they don't announce it. They don't warn anyone. In fact, their public statements often say the exact opposite. They tell you to stay invested. They tell you the fundamentals are strong. They tell you not to panic. And while they're saying that on television, they're heading for the exits. In 1929, the Morgans and the Rockefellers started liquidating positions in the summer, months before the October crash. Bernard Baruch, one of the richest men in America, was almost entirely in cash by September. Joseph Kennedy famously sold everything after a conversation with a shoeshine boy who started giving him stock tips. But the real reason Kennedy sold wasn't the shoeshine boy. It was that he had connections to people inside the banks who knew what was actually happening behind closed doors. Regular Americans kept buying. They were the exit liquidity for the smart money. In 2007, hedge funds started shorting subprime mortgages a full year before the crash became public knowledge. Goldman Sachs famously bet against the same mortgage securities they were actively selling to their own clients. Executives at Countrywide and other mortgage lenders were dumping their personal stock holdings while telling investors in public statements that everything was fine. Regular Americans kept buying houses and bank stocks. Once again, they were the exit liquidity. Now, let's look at today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, board members, the people who actually know what's happening inside these companies, are selling their own stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every insider buying shares of their own company, multiple insiders are selling. Meanwhile, retail investors, regular people with brokerage accounts, have been pouring money into the market at record rates. Robinhood accounts, 401k contributions, passive index flows, record amounts of money flowing in. The smart money is selling. The regular people are buying. This is not a coincidence. This is not random noise in the data. This is the pattern. This is exactly how it works every single time. Stage 3 is flashing red. This is the sneakiest stage because everything still looks completely normal on the surface. Prices are stable or even rising. Trading volumes appear healthy, nothing seems wrong, but underneath the surface, the liquidity that supports the market is quietly draining away. Liquidity is like oxygen for financial markets. When there's plenty of it, everything functions smoothly. Buyers and sellers can transact easily, prices adjust gradually, shocks get absorbed without major disruption. When liquidity disappears, markets stop functioning, prices don't adjust gradually, they gap. Small sell orders move prices by huge amounts. Feedback loops take over, the crash feeds on itself. In 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary conditions. They were trying to cool off speculation in the stock market. What they actually did was drain the liquidity that had been supporting asset prices. For a while, nothing happened. The market actually kept rising. People thought the Fed's tightening didn't matter. Then October came, and when selling started, there was nobody on the other side of the trade. The bids just vanished. Stocks didn't decline gradually. They went into free fall because there was literally no liquidity to absorb the selling pressure. In 2007 and 2008, the exact same thing happened. The Fed had been raising rates for years. Credit conditions were tightening, but the stock market stayed high. Housing prices stayed high. Everything seemed fine. Then Bear Stearns collapsed, then Lehman. And suddenly, everyone realized the liquidity was gone. The market dropped 50% in a matter of months. Now look at today. The Federal Reserve has raised interest rates at the fastest pace in 40 years. They've gone from 0 to over 5% in less than 2 years. They've been running quantitative tightening, actively pulling hundreds of billions of dollars out of the financial system. And yet the stock market is near all-time highs. People think this means the tightening doesn't matter. They think we've achieved a soft landing. They're wrong. The stress is already showing if you know where to look. In March 2023, 3 major banks failed in a single week. Silicon Valley Bank, Signature Bank, First Republic. These weren't tiny community banks. They failed because of a liquidity crisis directly caused by rising interest rates. The Fed had to step in with emergency lending programs. They essentially printed money to backstop the banking system while simultaneously claiming they weren't doing a bailout. Those emergency programs are temporary patches. They don't fix the underlying problem. They just delay the inevitable. The Treasury market, the foundation of the entire global financial system, has been showing serious signs of stress. There have been moments where liquidity in the Treasury market, supposedly the most liquid market in the world, nearly evaporated. The most liquid market in the world is having plumbing problems. This is stage 4, the liquidity illusion. Everything looks calm on the surface. Underneath, the oxygen is being sucked out of the room. This is the one nobody can predict, and that's exactly what makes it so dangerous. Stage 5 is the event that turns a vulnerable market into a collapsing market. It's the match that lights the fuse. Here's what most people fundamentally misunderstand about triggers. They think the trigger causes the crash. It doesn't. The crash is caused by stages 1 through 4. The debt, the concentration, the smart money exit, the liquidity drain. Those create the conditions for collapse. The trigger just determines when it happens. In 1929, the trigger was the Hatry case. Clarence Hatry was a British financier and company promoter who got arrested for fraud on September 20th. His companies, worth about £24 million, collapsed. Nobody in America had even heard of him. It seemed completely irrelevant to Wall Street, but British banks and investors had exposure to Hatry's companies. They had to raise cash quickly, so they sold their American investments. That selling created more selling. The pressure built. Within weeks, the market was in free fall. A minor British fraud case that affected less than 0.1% of the London market helped trigger the Great Depression. Not because the fraud itself mattered, but because the system was so fragile that any shock, no matter how small or seemingly irrelevant, would have done it. In 2008, the trigger was Lehman Brothers, but it could have been Bear Stearns 6 months earlier, or AIG, or any number of other institutions teetering on the edge. The system was primed to explode. Lehman was just the spark. So what's the trigger going to be this time? I don't know. Nobody knows. That's the nature of triggers. It could be geopolitical, a real escalation over Taiwan, something unexpected in the Middle East, a miscalculation with Russia. It could be financial, a major hedge fund blowing up, a sovereign debt crisis in Europe or Asia, a derivatives accident. And remember, the derivatives market represents over $600 trillion in notional value. One major counterparty failure could cascade through the entire system like dominoes. It could be something in the banking system, more regional banks failing, a run on a major institution, a crisis in commercial real estate that takes down the lenders who financed it. It could be political, a constitutional crisis, a debt ceiling standoff that goes wrong, a sudden loss of confidence in the dollar. Or it could be something nobody's even talking about right now. That's usually how it works. The trigger is never the thing everyone is worried about. It's the thing nobody sees coming. What I do know is this. When stages 1 through 4 are all flashing red, the trigger typically arrives within 12 to 24 months. We've had all 4 stages confirmed since late 2024. That puts the window somewhere in 2025 or 2026. Now let me be very clear about what this doesn't mean. I'm not telling you the market is going to crash tomorrow. Timing the exact moment is impossible. Markets can stay irrational longer than most people can stay solvent. Anyone who tells you they know exactly when the crash is coming is lying to you. I'm also not telling you to sell everything and hide in a bunker somewhere. That's not a strategy. That's panic. What I am telling you is that the specific conditions which preceded every major crash in the last century are present right now. All 5 stages are either active or approaching. This is not normal market volatility. This is not a drill. The question isn't whether you believe me. The question is what you're going to do with this information. Roger Babson didn't just predict the 1929 crash. He prepared for it. While everyone else was leveraged to the maximum, he held cash. While everyone else bought stocks at the top, he quietly bought farmland and hard assets. When the crash came, he was positioned not just to survive, but to thrive. Irving Fisher, the genius economist who mocked Babson, lost everything. His fortune, his reputation, his legacy. He spent the rest of his life trying to recover and never did. The difference between them wasn't intelligence. Fisher was probably smarter. The difference was that Babson paid attention to the signals. He respected the pattern. He positioned himself for what was actually coming instead of what he wished would happen. You have the same choice right now. You can look at the data I just showed you and decide it doesn't apply to you. Markets always recover eventually, right? This time could be different. Or you can ask yourself some uncomfortable questions. How much of your wealth is concentrated in the stock market right now? Not just your brokerage account, your retirement accounts, your pension if you have one, your home equity if you live in a bubble market. How much of that wealth is concentrated in a handful of mega-cap tech stocks through index funds? How much of your financial security depends on prices staying exactly where they are or going higher? If the market dropped 50% over the next 18 months, which is exactly what happened in 2008, would you be okay? Would you lose your retirement? Would you have to delay your plans by a decade or more? I'm not telling you what to do. I'm not a financial advisor. I'm a historian. I study patterns. And the pattern is absolutely clear. The people who get destroyed in crashes aren't stupid. They're just unprepared. They trust the experts who tell them everything is fine. They believe the system is more stable than it actually is. They assume someone would warn them if something was really wrong. Nobody warned regular people in 1929. Nobody warned them in 2008. Nobody's going to warn you now. The warning is the pattern itself, and now you know it. What you do next is entirely up to you. If this video helped you see something you didn't see before, subscribe and turn on notifications. I'm going to be breaking down each of these 5 stages in much more detail over the coming weeks, including the specific data points you can track yourself to monitor where we are in the sequence. Knowledge isn't power. Applied knowledge is power. The crash of 1929 didn't have to destroy so many lives. The signals were there. The pattern was clear. People simply chose not to see it. Don't make the same choice.